Pramod Gubbi, Managing Director and Head of Institutional Equities at Ambit Capital, joins us right now on the show. Pramod, good morning as always. Thanks so much for taking the time out and speaking with us at Bloomberg Quint. What's your sense, Pramod? I mean, we got one event out of the way, not that it was a really big market moving event anyways to be anticipated. There's one large global event slated next week. And if exit polls really determine what happens in elections, then we have two large events slated next week. How do the markets fare up until then?
Yeah, it's going to be an interesting phase, particularly given that it's end of the year, and ideally most people want to take their gains for the year and book profits and take home a decent Christmas bonus. On the other hand, I guess these events would not allow them to go quiet. Clearly, there's a lot of volatility on the anvil. So to that extent, I think the next 2-3 weeks will be interesting to watch. All we can say is there is volatility to be dealt with. But beyond the here and now, I think it is certainly looking more positive from the Indian fundamentals perspective. And also given the passing of the tax bill in the US, that's also augurs well from a fundamental standpoint, be it global fundamentals. So obviously the other controversies around it can throw a spanner in the works and may sort of delay that sort of a recovery, i.e. the fundamentals will recover, but perhaps the market will take longer to reflect those.
Mm-hmm. To talk about the elections first, what would really market be watching for? Is there a number that is very significant for markets, say 110 plus for BJP or 120 plus for BJP like they've been claiming, or at least in triple digits, or it is just the outcome, who forms the government and that's it?
Yeah, I think it's more than just forming the government. They want to, the market would like to see that the political stability is here to stay, and hence the stability and sustainability of the reform agenda is here to stay, going beyond the next 18 months, and they'd like to see that continue until the general election. So this is not simply about making, forming the government. You need a reasonable lead or a clear-cut majority in forming the government without a hitch. Anything less than that, I guess we're in for a bit of a doubtful 12-month period. Thankfully, there are other elections for the market to watch out for in the next 12-month period to figure out whether we'll have that continuity in the reform agenda when general elections come up in 2019.
And you also mentioned the developments in US. I think markets are now discounting a very high probability of the tax bill getting cleared before Christmas. You refer to some finer details. What are you actually watching out for?
I think that there are two versions of the bill, and they need to arrive at a common place. That I guess is again a pretty much a done deal. It was more about the investigations around the U.S. president and his aides in the past, which could create some sort of short-term news flow, which can be negative for the markets. But we've seen, this tenure of the US president hasn't been without controversies, so we passed through every controversy. More likely the market will overlook that as well. But the interesting piece from the US is the rotation that we are seeing, rotation into more economy-focused stocks away from tech, and that augurs well for the rest of the emerging markets, because once the real economy in the US and the Western world picks up, it has to be positive for emerging economies, including that of India, more so for commodity and export-driven economies, but I guess India should also be a beneficiary from that. So that's clearly another fundamental positive to look forward to.
Is there any of these developments that could meaningfully alter, the approach of FIIs with regard to the Indian markets, because they have been mostly active on the sell side?
Yeah, I guess in the short term, you could see some sort of money going back into developed markets, given, finally after a long hiatus, there is some real investment in the economy, and you can expect these economies to deliver beyond just the tech sector that have pretty much held up these markets. So there's a huge scope for rotation-driven return generation in developed markets. That might drive some flow out of emerging markets in general, including that in India in the shorter term. But like I said, once the effects of a growing America or growing developed world trickles down into emerging economies, I think we'll be back to looking at emerging markets as a favored asset class. So maybe in 6 to 12 months' time.
6 to 12 months' time. Well, that's the time frame in which we might expect this view to change. But what are you really advising your big clients? What should be the strategy in Indian markets? Because index is kind of struggling. A whole host of stocks continue to do well. What should really one look at? What segments to really focus, or should one be hedging? On whatever long positions or the portfolio holdings one has.
Yeah, I mean, we see the policy actions over the past month or two by the Indian government as sort of a quasi-stimulus to the economy, and clearly, the sort of GST rate cuts and the leeway around GST, the Bharatmala program, and so on, will clearly have its own positive effects on boosting growth, in particular consumption as well. So in the run-up to the elections, we expect consumption to hold steady. So to that extent, consumer stocks, particularly consumer discretionary, becoming an interesting sector. Of course, valuations aren't cheap there, but given there is visibility of earnings growth, that's certainly a sector to look at. And also on the investment side, given the roads program, the recapitalization of the PSU banks, will allow more funding to be available for infrastructure build-out and so on. So to that extent, I think industrial stocks, construction stocks, EPC, particularly exposed to roads and buildings, should do well in the coming days. On the other hand, I guess all these stimuli will necessarily lead to expansion of the fiscal deficit, as we witnessed. The bond yields are already indicating that. There could be an increase in cost of funding for lenders, particularly banks and NBFCs who are increasingly exposed to the wholesale market. You could see some of these margins getting crunched, and given the lofty valuations, that's a place where you can book profits and move into the sectors that I just highlighted.
Okay. Just looking at what's really happening in the markets currently, clearly on the broader end of the spectrum, it's future consumer enterprises which is hogging the limelight because of that brokerage note that came in. Moil is amongst the others, which has bounced back or done very well today, up about 4.5%. There is strength in Escorts, about 2.5% as well. But aside of that, it's a fairly sedate Nifty 500, not enough big movers at the start of the trading day. Let's see if these build up during the course of the session. But for now, in the first 5 or 6 or 11 minutes, there's only one name which has had double-digit gains. I'm using that as the crutch for my next question, Pramod. Consumption, such a wide basket. Where are you on this now? There's a bit of a rally that is played out. There is valuation looking expensive in a clutch of these names as well, but the story probably still continues for the foreseeable future. What is the Ambit stance here? And within the different facets of consumption, are you guys starting to get a bit sketchy or negative about any of these?
Not really. Perhaps 3 months ago we would have been a bit concerned, given valuations are going up without any sort of visibility on earnings. But I think these stimulus measures, and clearly they're going to stay until the general elections, which is a good 18-month period. And on top of that, I think the rural economy is looking up after a couple of decent or normal monsoons. You've had an MSP increase coming in after a long time. You have farm loan waivers. So along with these stimulus measures in terms of tax cuts around GST, etc., you should think that there is at least the growth for these sectors is sort of underpinned, at least for the next 2-year period. So to that extent, in a market where earnings growth has been elusive, You don't mind staying in sectors where valuations are higher, but yet you have some sort of earnings visibility. So wherever there is growth, I think the market will veer towards that, and consumption is something which is right up there.
Okay. And what about consumer financing? Those stocks have had a really fabulous run, Pramod, a handful of them right now, and they're now starting to face competition in a bigger way from banks as well. I mean, I'm just referring to going to buy one white good, and a clutch of names aside of Bajaj Finance, which are now offering the same product and probably in a much more convenient fashion. You just need that credit card and you don't need to bother about anything else. Is competition rising on the anvil in a big way, and would that play a part, or is the landscape large enough for growth to continue for the foreseeable future?
Yeah, I think the landscape is large enough, and there are different segments, and the economy is large enough where you can tap into newer and newer segments to sort of defend your market share. But having said that, I think there is clearly competition coming in, and we're already seeing that in terms of yields being lower, particularly in urban areas where entry barriers, or it's easier for a new entrant to come and make a dent very quickly. So to maintain this sort of yields, I guess some of the incumbents will have to go deeper into higher yield territories, which again is not free of risks in terms of asset quality. Availability of data to appraise consumers isn't easy, because the metro and the urban areas are by and large covered through CIBIL and other sources, but credit appraisal becomes a challenge as you go deeper. But the bigger risk we see for some of these NBFCs in the shorter term is the cost of funding going up. Clearly seeing bond yields going up, commercial paper rates are also going up. Commercial paper market has been one of the widely tapped market for NBFCs as a source of funding, as they moved away their liabilities from banks to the bond market. And if the bond market costs are rising, I guess you can clearly see pressure on margins, particularly if they don't have flexibility on the yields. You will see that having a double whammy in terms of both cost of funds going up and yields crunching. So margins compressing is perhaps the bigger risk in the near term for these NBFCs than competition alone.
And how are you watching the developments in commodities market, Pramod? What's your call on this entire segment?
I think that's, again, very difficult to call from a domestic perspective, given it's a global sector, and something which has been much dependent on what happens in China. I think that remains to be seen as to, we saw, in brief, after the Chinese Communist Party event, we saw some sort of tightening in terms of spending in China, which could have been a bigger risk. But then, if you expect the tax bill being passed in the US leading to some sort of spending on infrastructure and finally some capex activity picking up globally, that should augur well for commodities in general. To that extent, I think even locally, we expect some sort of spending on infrastructure and building activities, which could have a positive impact on demand for commodities. And from a price standpoint, that should stay put, and metals and commodities should be in for a good run through the next 12-month period as well.
Are you bullish on metal stocks, both steel and base metal, in Indian markets?
Yeah, I mean, like I said, the same drivers apply, particularly if there is a massive infrastructure build-out plan. And at some stage, I guess we'll have to push housing as well in terms of because it's the largest source of job creation. The government will pay attention towards housing, and with housing and infrastructure build-out, you will see steel and other commodities related to that. Generally, building materials in general should gain from that sort of a stimulus.
And would you also be looking to play the housing opportunity directly through some of the real estate names?
Not yet. Maybe it's better to play through, building material providers and ancillary companies than real estate developers just yet, because we're yet to see a meaningful consolidation there. We're seeing the beginnings of it, but at some stage, you will see the marginal players going out of business. And once the consolidation happens, I guess it will be easier to pick and choose, which developers to play for. So perhaps early days, but definitely a space worth watching out for.
Pramod, last couple of questions really. Firstly, I don't know if you're at liberty to talk about this, but one note that I really liked from amongst the many that Ambit came out with recently was this, I don't remember the title of the note, but it was stars within India, or small stars within India, which have the scope to become really large in the world. Some of these were not rated by your house, some of these were rated. I don't know if you kind of understand the note I'm talking about, but it had coverage on 8 companies which were probably leaders within India in their own pockets and are now expanding to the wider world. SL Propack, Symphony, Vinati Organics, etc. I mean, what is driving you to identify these kind of players? And if you're at liberty to talk about the business of maybe one of those that you may be liking within this pocket. I think you guys have a buy on Vinati Organics, if I'm not wrong there.
Yeah, I'd resist talking about any single company or a stock, but the theme we are generally looking at, this is something that we tend to do time and again, try and come up with new themes, new ways of looking at stocks to be able to help our clients discover new stocks which are underpinned by these themes. So to that extent, one of the themes we looked at is those who have managed to execute these businesses very well in the domestic market and have the ingredients to tap into a much larger opportunity through a global market, putting in the ingredients in place, such as branding and distribution and channel partners. So that's one of the things. It's called the little giants. So we expect some of these companies, if not all, to go on to become global leaders in their niches and subsegments. And that'll be an interesting story to play for investors interested in that sort of a market segment, which is largely small to mid cap.
A large number of mid-cap chemical companies or some other commodity companies have actually benefited by these steps taken by the Chinese government, like say also in graphite electrodes. Do you really expect this theme to kind of sustain? Are these just a seasonal trading opportunities or long-term play really where one could stay invested?
I think that the theme is here to stay. I think China is clearly serious about its pollution and pollution control measures. To that extent, you will time and again see various opportunities coming up, just like we've seen in the area of specialty chemicals. One other area has been in the area of arc furnaces, which have clearly given a boost towards the usage of graphite anodes. At the end of the day, though, it is still a commodity. I think there will be periods of time when the opportunity emerges and demand significantly exceeds supply. But given at the end of the day, it's a commodity business, supply sooner or later catches up and the price of that commodity sort of eases. So I wouldn't say it is a structural play, but like in most commodity businesses, you get these points in time where you need to get into and play it out over a couple of years period.
Okay, Pramod, final question from mine, but just before that, I want to mark 2 or 3 names, just before I take in the final thought from Pramod Gubbi, at least from my end. One of them is a stock called Tarmat. It's a small cap stock, but was up about 20% yesterday, up another 7.5% in today's session. So that's Tarmat, 8% now. The other one is Prabhat Dairy. It's been enjoying a stellar run the last few days, up another 3%, and this takes the stock to life highs, 177 and counting, so good going there. And lo behold, Mindtree is on a roll, another 2.5%, now 570 for Mindtree. Difficult to look at mid caps and small caps in particular, Pramod, but 2 pockets that I want to bring out. I know you guys track both. One of them would be mid cap IT. Obviously, everybody would be tracking it, but you guys also have a fairly strong coverage on the dairy sector. I remember reports about Heritage and a couple of others, Hudson, if I'm not wrong, some time back too. What's your stance or what's your call on these two? One is emerging from the ashes, so to say. The other one has been enjoying a prime run for a while now.
Yeah, I think IT finally could be looking up. We've talked about the attractive valuations in the sector, but I think with a clear view coming in from the US, particularly with the passing of this tax bill, you can expect IT spending in the US to pick up clearly. So the tax cuts clearly leave a lot of money in the hands of the corporations. And maybe finally you could see some sort of trickle-down effect in terms of that spurt in spending towards Indian IT companies. But in the shorter term, I think the impact will be more in terms of the currency, where this sort of a fiscal stimulus in the US will clearly push up dollar as a currency, and that should certainly augur well for Indian IT. So you have a short-term boost in the form of the currency, and perhaps over the medium term you will benefit from the spending in the US. As far as dairy is concerned, I think it's a structural story. It is right up there in terms of formalization. As the country moves its consumption basket, food consumption basket towards more protein-driven foods, the demand for dairy products should certainly go up across the board, and not just in terms of the premium products such as cheese and so on, but also in terms of primary pasteurized milk has significant growth drivers going forward. At the same time, given the changes that the government has brought in through demonetization, GST, and attack on black money and so on, it's right up there in terms of a formalization play. So the formal names, the organized guys who have brand and distribution across the country, particularly sourcing, that's also a key competitive advantage in dairy. These clearly have the opportunity to gain share from the unorganized guys and also benefit from the long-term growth story in the dairy market.
I know we're running out of time, but one last question, Pramod, from my side. Some of these domestic-driven themes which have done quite well over 2017, one would say, for example, liquor. You have retail that includes gems and jewelry retailing companies. You have aviation. That sector has seen 18 to 20% kind of year-on-year growth, almost month after month. Do you like any of these themes or anything else where one could find some of the interesting ideas in the smaller large cap or a bigger mid cap stocks that one can buy into?
I think we like pretty much all of them. Like I said, in the near term, clearly you have a stimulus coming in, which should help spending. The tax rate cuts in GST will also play up to this sector. So anything playing into the discretionary spending theme from the consumer standpoint will definitely benefit in the short term. But more so in the longer run, I guess, particularly sectors such as retail that you mentioned, which also have real estate as an input, and we are looking at real estate prices correcting significantly. If your key input sort of becomes cheaper, then retail companies are here to perform and benefit from that sort of a correction. So consumer discretionary in general, within that, I think jewelry, apparel, footwear, even airlines could have a clear boost from this sort of a spending or rather stimulus from the government.
Okay. Pramod, we'll leave it at that. Thanks so much for taking the time out and speaking with us for an extended session, but wanted all your views and we got them. So thanks for being with us today.